problem is people don't understand what diversification means. They think if they have 50 stocks in 10 sectors, semiconductors, consumer non-durables, or whatever, they're diversified. And what I say to them is, you may have 50 stocks, but that's one asset class. You're in stocks. And in stressful situations, they become highly correlated. So you're not getting the benefit of diversification. You think you are, but you're not. So what does a diversified portfolio look like? Well, I have a slice of stocks. I'm not anti-stock market, but you got to pick the sectors and the stocks that will perform well, even in the kind of conditions we're talking about. And I would go back to energy, natural resources, agriculture. So, a Marathon, ExxonMobil, Chevron, ADM, Cargill, mining companies, and not just gold, yeah, but I recently invested in a lithium mine. I think the climate alarmists, I think the Green New Deal, I call it the Green New Scam. This is a scam, but it doesn't mean it doesn't have legs, whether you like it or not. The fact is, it's going to go on. So the lithium's in short supply, graphite, et cetera. So there is a portfolio you can have, which is natural resource oriented, that will do well, even in the kind of tough environment we're talking about. Slug cash, absolutely, maybe as much as 30%. I like treasury notes, 10-year treasury notes, but seasoned to taste. If they're a little too volatile, look at 5-year notes, 2-year notes. They're going to come down a lot, not right away, not tomorrow morning, but sooner than later, because of everything we discussed, which is a recession and interest rates will follow. They're a lagging indicator, but that'll happen. Gold, I always recommend 10% slice. Absolutely. There's hate to get too deep in the weeds in terms of bond math, but there's something called a DV01. DV01 is the dollar value of 1 basis point. What that means is, obviously, basic bond math, interest rates come down, the price of the bond goes up. They're just inverse. It's a little counterintuitive, but rates come down, the bond goes up. The question is how much? And the lower the interest rate, the more the price of the bond goes up for every basis point drop in rates. So in other words, if you go from 9% to 8%, you'll have a nice capital gain on your bond. But if you go from 3% to 2%, it's still a 1% drop, but you're going to have a much bigger capital gain. In each instance, it's a 1% drop in rates, but the amount of capital gain on the bond is much higher. As the DV01 is higher when the rates are lower. Again, it's all counterintuitive. But the lower the rate, the greater the capital gain on each basis point drop. That's basically. So yeah, when you go from 3% to 2%, that's a home run in terms of capital gains. So you get the yield, you get the safety, you get the liquidity, and if you feel like selling it, you got a nice fat capital gain. Yeah, but based on what we were talking about, I would get silver dollars, American Silver Eagles. Yeah, the Monster Box. That's bit of jargon. Monster Box comes from the U.S. Mint. It's Treasury green, nice shade of green. It comes with a compression strap. I recommend don't open it, unless do not break except in case of fire. But inside are 500 1-ounce American Silver Eagles. That's a lot. They'll feed your family for probably a year, and they run. It's a market price, but be around $10,000-$12,000 for a Monster Box. But to me, it's like battery and flashlights. Just have one, stick it in a safe place. Yeah, I like them both, and I talk about gold a lot because it's a form of money, and I do the monetary analysis. I do invest in gold mines, but I don't hold myself out as a geologist. But I do think about it from a monetary perspective. And then people always say, "Jim, what about silver? What about silver?" I'm like, look, if gold soars the way I expect, silver's along for the ride. There's not going to be a world of $3,000 gold and $20 silver. That world doesn't exist. If gold's at 3,000, silver's going to be pushing 100. So without giving an exact forecast, silver will be along for the ride. Silver is a little more difficult to analyze because it has industrial applications. Gold really doesn't. Gold's not good for anything except money, but it's the best form of money. Silver is used in a lot of applications. So if you have a recession, it's perhaps the case that the monetary value is going up, but the industrial input value is going down. So it's a little bit more of a mixed bag, but silver is going to do fine. And I do think it's extremely practical because in a world of CBDCs, silver will be a form of spending money. Gold, even the 8-gram coin I mentioned, the quarter ounce American Gold Eagle, still $500. It's like pulling a $500 bill out of your wallet. You know, it's a lot for groceries. Yeah, income producing real estate. I wouldn't get into commercial real estate, residential. Yeah, the prices are, home prices are coming down a little more in some markets than others. But if it's income producing and it's solid and it's in a place like, someplace people want to be, like Austin or Phoenix or whatever. I mean, I know there's markets down a little bit right now, but it's like buying a 10-year bond. It's got steady monthly income and or certainly farmland, but income producing real estate, not commercial office buildings, should be a part of a diversified portfolio. Yes. I like private equity, and it's, you got accredited investor issues and finding good deals and good promoters and good management. But, there's some, some good deals in the mining sector. I like, seriously, everything we talked about is sort of pales in comparison to what's going on in Ukraine. We're kind of on a march toward nuclear war. If you talk about what they call legacy media, mainstream media, so Washington Post, New York Times, LA Times, NBC, ABC, CBS, MSNBC, CNN, that run of characters, the first thing you discover is, I know a lot of these people. I've been on all these programs. I've done this for a long time. I spent a lot of time in Washington, had dinner with most of or lunch or whatever, dinner actually more often with most of the names you've heard about. Some of them are fine, some of them nice. A lot of them are either not that bright, or, they're good on camera, or whatever. They got a desk at the Washington Post. They're not that bright. Or if they've got some degrees, they've been kind of indoctrinated. We're at the point now. A lot of these people are 28, 33, 34 years old. There's nothing wrong with that. That's, good. You're in the heart of your career. But that means they graduated from school in, 2016, 2017, or whatever. And they're thoroughly indoctrinated. I went to school when we learned, it was pretty rigorous. I had one program where they graded, you needed a C+ average to graduate, but they graded on a C- curve. So you're like, how do you get it? How do you even get a C+ if they're grading on a C- curve? The answer is people quit. And in other words, you were trying to struggle to be. I did get an A in partnership taxation. I'm proud of that. But the standards are down. The emission standards are down. Affirmative action takes over. When you get into the classroom, I don't care where you're at, Ivy League, whatever, it's just indoctrination. The market has a way of sorting it out. If revenues are down, advertising's down, viewers are down, subscriptions are down, eventually, as you said, they will go out of business, not overnight. And then new media channels will arise. And, there's a lot of garbage on the internet, but there's a lot of good stuff. And, if you want to keep tabs on the war in Ukraine, you have to know where to look. It's not easy, but there are a number of channels and I'm talking about, military officers, colonels, brigadier generals, people on the ground in Ukraine, not, some studio in New York. You can find out what's going on. But I think my intelligence training is helpful because you have to be very persistent and know how to dig. Whatever your baseline is, probably treasuries, 2-year notes or 5-year notes or whatever, they will come down a lot. Not right away. We may still be a month or two away on this, but they'll come down a lot. The interest rates are a lagging indicator. Everyone's like, well, how could interest rates be, going up if we're in a recession? The answer is, as you get close to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. But the stock market is saying, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. And because of a recession, this is the soft landing Goldilocks scenario, where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks. So here we see Wall Street in real time kind of bidding up tech stocks because the Fed's going to pivot and cut rates. When in fact, Powell's thinking, no, that's not happening until 2024. So that's what the Fed thinks is happening. The market thinks that Powell is over tightening, that inflation will come down faster and the pivot will happen sooner. And that's why we've seen a little bit of a rally in stocks recently. So you have the Fed narrative, that's plan A. You have the market's version of what the Fed's actually doing, which is plan B. My estimate is that they're already past the terminal rate. They don't know it. They don't think so, but they are. And as I said, inflation is going to come down a lot faster than anyone expects. I talked about how the Fed is blundering because they're raising rates too high, too fast, et cetera, and they are. But the Fed has always said, we don't worry about inflation. We don't like it, but we know how to get rid of it. We just raise rates, and maybe they got to raise them longer and further than people expect, and maybe it's painful. There are costs involved, but they can kill inflation just by raising rates. They don't know how to stop deflation. I mean, how do you stop deflation? Can't raise rates. That'll make it worse. You can go to zero, but that doesn't, once you're at zero, you're at zero. QE doesn't work, by the way. It's been tried to the tune of like $9 trillion, but the empirical evidence is that it's just, they do QE by buying bonds from the banks, and the banks take the money and give it back to the Fed as excess reserves. That money never goes to the economy. What good does that do? And the answer is it doesn't do any good. It's a triple, greatest bubble of all time, times 3, in the sense that it's real estate, stocks, and other asset classes. So I do, that is my view, but it's shared by a number of other analysts. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last, how are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? They're two different things. The global economy is the big topic. That's what we all care about most. But financial markets can come up with their own narratives and go their own way, at least for a while. So you have to, they're not in sync. They will be in sync eventually, but not always right away. A lot of times the financial markets get ahead of themselves, and then they wake up to reality and they, crash, correct down. But in terms of the global economy, I think your use of the word global is very much on point, because it's often the case that, you look around the world, you've got the United States, or, North America, if you want to throw in Canada, you've got the EU, you've got China, you've got Japan, they're all important economies. But they can kind of be in different parts of the business cycle. And it's not unusual for one part to be in recession, but another part of the world is like doing better. So then they use the phrase locomotive theory. The locomotive is going to pull us all out of the ditch, and we'll get going. So it's not unusual to have recessions in the United States or Europe, or particular countries in Europe or Japan. I mean, Japan's had 9 recessions since 1989. I mean, 9. I consider that one long 30-year depression. That's a debate for another day, but that's how I would describe Japan. But it usually, one's not doing so well and another part of the world's doing better. That's not the case. What is happening right now, I see it, but there's an awful lot of data to back it up, is that we are going into, or may already be in, a global recession. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession based on a lot of factors, some of which we've spoken about. Now, the other half of your question, which is important to listeners, is what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got 3 Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling 3 different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So the Fed story kind of goes like this. The Fed, forecasting what the Fed's going to do is the easiest thing I do. It's not because I have a crystal ball or I'm smarter than anyone else. The Fed actually tells you. All you have to do is listen and believe them. Now, a lot of people don't listen, or they listen like, oh, the Fed will never do that. They will. They actually mean it. Japan had the famous lost decade. Well, the lost decade was 20 years ago. Started in 1990 through 2000. Japan's now almost at the end of their third lost decade. The United States has had a lost decade from 2007. We're probably, if something doesn't change, either in terms of policy or a collapse, something gets worse. But absent that, we're going to remain in this kind of punk 2% growth as far as the eye can see. People say, oh, well, second quarter GDP, Atlanta Fed predicts, 4.5%. Yeah, but we've had 4 and 5% quarters in the last 9 years. They don't last. You get these spikes, you get a real good, 4% print, and then the next quarter is 2%. The one after that is 0.5 or maybe even a negative quarter. So the headwinds, demographic, technological, productivity, psychological, et cetera, haven't changed, and there's no reason to expect they'll change. So you can't understand debt in isolation. You have to understand debt relative to income. And that debt to GDP ratio, which is something I spent a lot of time looking at, the GDP is kind of chugging along, not going up very much, but the debt's going like this. The debt to GDP ratio is getting worse. I would say that the Fed's monetary policy will fail or is failing, and fiscal policy will fail, is in the process of failing, even if gold didn't exist. If you didn't have gold as a, multi-millennial monetary standard, even if gold wasn't there as a reference point, which of course it is, but these policies are failing anyway, and there are a lot of reasons for that. Whenever I hear fiscal stimulus, I say, well, no, the Fed can print money all day long and the Congress can spend money all day long, but don't call it stimulus. It's not going to have any stimulative effect. We're way past the Keynesian multiplier, which is now below 1, meaning if you borrow $1 and spend $1, you don't even get $1's worth of GDP. You get some numbers, 70, 80 cents. Forget about the multiplier. It's actually now, a divider, something that reduces GDP. Well, you don't get the GDP for the borrowing. And same thing with monetary policy, because unlike Milton Friedman, the monetarists, the neo-Keynesians, the Austrians, and everyone else, money printing has nothing to do with inflation. And they seem to, well, I don't know if they ever knew it, so I can't say they forgot it. So all the money printing and all the deficit spending will not stimulate the economy. And that's true anyway, but gold is signaling that. Look, all markets try to be forward-leaning. Some do it more successfully than others, more accurately than others, but they try. I would say that, yeah, people say, the stock market is an efficient discounting mechanism for future events, for what they see in the future. And yeah, they look into the future. Here's the forecast. They pick out a discount factor. They present value it and say, here's where stocks should be today, based on where things are going to be, 6 months or a year from now. And that's what they do sort of mathematically and analytically, except they're always wrong about the forecast. You got to get the forecast right if the discounting process is going to mean anything. So markets go through the process, but they always get the future wrong. They're not very good at predictive analytics. So this creates what I call the gap between the perception and the reality. Reality always wins, but not right away. Sometimes it takes a while. Gold, on the other hand, has very high predictive analytic value, number one. Number two, it's more forward-looking. So gold's kind of telling you where things are going to be maybe a year to 18 months from now instead of 6 months from now. And so, so gold is signaling that monetary and fiscal policy will fail and something else will be tried. And that ultimately will result in a much higher price for gold. So gold's just saying, well, let's do it now. Look, I've got gold at $15,000 an ounce by 2025. If I'm wrong about that, it'll be sooner and higher. But that's, well, I consider that a conservative forecast. And we can maybe take a few minutes to go into the analytics behind that. As I've said before, you've heard me say, I don't just throw numbers out there to get attention. I don't really care. I do care about getting the analysis right. There's a number of different techniques. And what's interesting is they all point in the same direction. So So, you know, it's got to go to 3,000 before it gets to 15,000. It's got to go to 5,000 before it gets to 15,000. So that's my kind of long range forecast. But, you know, it could go down tomorrow. And I'm like, I don't get depressed when it goes down. I don't get euphoric when it goes up. I know where it's going in the long run. That's the important thing for if you're trying to preserve wealth and make money. You know, nothing wrong with making money. I'm all for it. But sometimes preserving wealth, you know, and risk aversion is a higher priority than just making a lot of money in the short run. But either way, gold will serve that purpose and you know, and preserve wealth over that time period. Could it go down tomorrow? I guess, yeah. But all the vectors are pointing up very strongly. And I'll give you a concrete example. There are three things that drive the price of gold fundamentally. One that you've already mentioned, which is real interest rates. The lower the real interest rate, the higher the price of gold. Number two, supply and demand. You know, you learn it in your first 3 days in economics, but it still works. And then number three is geopolitical risk. You know, call it risk off or fear factor, whatever you want to call it, but I think of it in geopolitical space. Those three vectors don't all have to point in the same direction. You could have a situation where geopolitical risk is high, pointing to a higher gold price, but real interest rates are really high, and that would point to a lower gold price, et cetera. But right now, all three of them are flashing green or maybe flashing gold. The real rates are coming down. They're still high, by the way. When I always have to just roll my eyes when like really smart people, Dan Isaacson, Bill Gross, Jeff Gundlach, and I admire them all and I follow them all. But they've all been carried out feet first on this, you know, bond bubble thing, you know, the greatest bond bubble in history, and short bonds, and the interest rates have nowhere to go but up. They're just failing to distinguish between nominal rates and real rates. Nominal rates are low. Real rates are not low. When I say low, I mean, show me negative 4%. That's a low real rate. Yeah, you can pick your notes or your bills or whatever, but I usually use the 10-year note rate, 10-year treasury, because it's a good proxy for building, construction, long-term investment. People don't borrow overnight to build a building. They borrow for 7 years if they can, et cetera. So to me, that's my proxy for sort of economic growth and inflation forecasting. That's it's about 70 basis points today, et cetera. But inflation is, you know, 1.5, take your index. So that puts the real rate, you know, maybe negative 25, negative 50 basis points. Well, thank you very much. But, you know, I remind people in 1980, I borrowed money at 13%, but inflation was 15%. And my borrowings were tax deductible, and the tax rate, I lived in New York City at the time, was 50%. So my real after-tax rate was about negative 7. That's a low real rate. So the point is, we have a long way to go. And it doesn't matter, you know, people are interested in whether the Fed's going to pursue a negative interest rate policy, take the target rate on Fed funds below zero. Legally, they could. It's already been done in Europe and Switzerland, Japan, a few other places. I don't necessarily forecast that. I don't think the Fed necessarily wants to go there. But you can have negative yield to maturity on a 10-year note. Just whenever the premium is greater than the present value of the coupons, it's a negative yield to maturity. So you can get there. You can get deeply negative rates in secondary market trading, regardless of what the Fed does. And that will happen. And so, you know, in the DV01, dollar value of 1 basis point is higher as the absolute level of rates gets lower. That's just, you know, duration, just bond math 101. So we're going to have huge capital gains in 10-year notes as the yield to maturity goes, you know, towards negative 1%. But that's going to be an enormous boost for gold. And we're not even there yet. We're seeing kind of a spike in gold prices when real rates are still, you know, relatively high. They're only mildly negative. I was declarative when I said printing money does not cause inflation, and it doesn't. Again, I'll just use the last 12 years as Exhibit A. We should probably relate to the viewers what does cause inflation. And the answer is velocity, the turnover of money, the lending and the spending. But the problem is velocity is a psychological phenomenon. The Fed can stick the landing on money supply. They can get it down to a couple of decimal places if they want. But if you want to control velocity, which is the key, that's psychological. So what you have to do is change the psychology. Well, what is the psychology right now? It's deflationary. The savings rate in May was 33%. You know, it had been going up. It kind of made its way like from 4% to 7%, but then it spikes to 33%. Well, savings is a good thing. You can drive an economy if you can convert savings into investment. And furthermore, if the investment is productive, unlike what China's doing. But we got some infrastructure or some other projects, R&D that would be productive. That can drive an economy. You don't have to drive an economy on consumption. You can drive an economy on productive investment. But the problem is twofold. Number one, it has a much longer time frame. That's a 5-7 year time frame. And it comes, in the short run at least, at the expense of consumption. Our economy is driven 70% by consumption. If you substitute savings for consumption, you're killing velocity. Because if I put my money in the bank and leave it there, the velocity is zero. And I remind people, $5 trillion or $6 trillion times zero is zero. You can print all the money you want, but if you don't have velocity, you don't have an economy. And so the question is, how do you change the psychology? How do you get and by the way, it makes sense to say, if you're unemployed, you better be saving because you're maybe lucky if you can pay the rent. But even people who are working or still have their jobs, they're worried, maybe I'm next. Maybe they fired the guy down the hall, but maybe I'm next, and maybe I better save more just in case, and so forth. So, and that's not a bad thing. I'm not saying that doesn't make sense. That makes a lot of sense, but understand what it means. It's deflationary. It reduces velocity. It offsets the increase in the money supply, and it's very hard to get out of. I mean, Keynes called it a liquidity trap, and he was right. That's what it is. So how do you change the psychology? Well, you need something big. You need something dramatic that's going to get people to say, wait a second, what's going on here? Well, one of them would be a $5,000 price for gold.
What has been happening in the U.S. economy? The Fed prints all this money, yet that money doesn't lose a lot of value. Look at the exchange rate of the dollar versus other currencies. We've had this massive explosion of money printing, big increase in the Fed's balance sheet. But on a relative basis, the dollar hasn't lost a lot of value relative to other currencies, despite the fact that we've dramatically increased the supply. Imagine if the United States existed as an island. We didn't trade with any other nation. So any money the Federal Reserve printed just stayed within our borders. It didn't go anywhere, right? And so the only stuff you could buy with the money the Fed printed was the stuff that we made here domestically, because that was the only source of goods. Well, obviously the effect would have been much different, because if the Fed prints a bunch of money and we don't have any stuff, we're not producing, we don't have factories making stuff, then the prices are obviously going to go way up. But there was kind of like an escape valve that allowed the Fed to print a lot of money and it not push up the price of goods. And that was the fact that we have a whole world out there that was able to produce the goods that the U.S. economy couldn't. And we were able to take all the money that the Federal Reserve printed and then use that money to buy all those goods that were made outside the United States. So the Fed prints money, right? The government gets it, sends it to Americans. Americans take that money and buy Chinese goods with it. And now the Chinese send us their goods and we send the Chinese our money. So the money the Fed creates is shipped abroad. So it's not in America bidding up prices, but now the goods that the Chinese produced, they get shipped to America. So now we have all those extra goods to keep a lid on prices. And if you look at the breakdown of the CPI between goods and services, if you just look at services, you've seen a substantial increase in prices, even with the government rigging the CPI, because the cost of services has actually risen by more than what the government admits. But if you strip out goods, you'll see a much bigger increase in prices. Why? Because we can't easily import those services. There isn't a foreign alternative. You can't outsource that stuff because the services have to be performed locally. But when it comes to goods, more and more goods have been outsourced to cheaper production economies like China. And so that's kept the lid on goods prices. And so when you average the goods prices with the service prices, that's kept the measured rate of inflation lower. I mean, think about the low production costs in a country like China, which, 20 years ago, they were just starting out. They went through a long period of time where they had a communist system, not just in name, but in practice. And so you had a lot of very poor people. And as they began to embrace capitalism, wages started at a very low level. And of course, they didn't have a lot of the rules and regulations that we had. They didn't have all these environmental protections. And so the cost of manufacturing and the cost of labor, capital was all much lower in a country like China. And so we were able to outsource that production in order to keep costs down, even as the Federal Reserve was printing money. And of course, the money that we were printing, we were sending abroad. See, now normally this wouldn't work, because if you ran a big trade deficit like the one the U.S. is running, your currency would crash, because your trading partners would have all this currency, but they'd have nothing to buy, because the whole purpose of trade is that you export to import. You have a concept of comparative advantage. And if, as a nation, there are certain things that you can produce efficiently, and there are other things that you can't, rather than producing everything, you produce just what you can make efficiently, and then you trade that for the things that you don't produce efficiently, because maybe your trading partner can produce that more efficiently. And so by everybody concentrating on what they make efficiently and then trading, everybody ends up with more stuff, higher living standards, lower prices. But the goal of your exports is to pay for your imports. You don't just export for the sake of exporting. That's just a waste of resources. You export to pay for your imports. But what about America? You've got China and other countries exporting to the United States. They're not getting imports. They're getting dollars. And because the U.S. is the reserve currency, those dollars are actually valuable. And so our trading partners are content, or have been in the past, to exchange the products that they produce for the money that we print. Now, their willingness to continue to do that and pursue this arrangement, I think, is coming to an end. I think the world is going to tire of exchanging real goods for our paper, especially when they understand how much less that paper is going to be worth in the future than it is now, when they realize the box that the Fed is in with respect to its ability to control inflation, and the fact that government deficits are going to keep on getting bigger and bigger and bigger, putting more and more pressure on the Federal Reserve to monetize those deficits. And in fact, the reason that the deficits were able to get so big in the first place was because of this arrangement, because foreigners were willing to hold on to our U.S. treasuries and keep interest rates artificially low. That emboldened the government to go even deeper into debt, because normally a government that was this profligate would be punished by higher interest rates, and that punishment would change their behavior and cause more fiscal responsibility. But we never got punished. And as a result of that, we continue to pursue even more reckless policies than we had in the past. And so foreigners actually helped encourage this. And ultimately now they're going to be the ones that are going to put on the brakes, because they're going to stop enabling all of this debt. But it's going to be the Federal Reserve that is going to ultimately replace foreign buyers of U.S. treasuries. But of course, when foreigners buy U.S. treasuries, there's no new dollars created. They buy treasuries with the dollars that already exist. But when the Federal Reserve has to buy those treasuries, they have to produce even more dollars to finance it, which is inflation. And of course, if those dollars stay here, if they're not exported, then they are going to be bidding up prices. And this is what Powell doesn't understand. We are not going to be able to continue to export our inflation to the degree that we did. And we're going to start to see goods prices rising now. And of course, even if the Fed hadn't increased the pace of its money printing, the benefits of outsourcing our production to countries like China was bound to diminish over time as Chinese wages go up, as production costs go up. There is less of a benefit of continuing to shift production abroad. And of course, as we've shifted more and more production abroad, there's less incremental benefit from shifting more. See, in the early days of outsourcing, we got a lot of bang for the buck, but over time, that impact is lessened. And so the benefit that we got of having our consumer prices reduced as a result of that is also getting diminished. So it was going to happen anyway, but we've now dramatically accelerated it.
I write books, and I also write several financial newsletters. So I'm thinking about topics all the time. And there's always one, usually you say, well, all right, this war in Ukraine is a really big deal. Got to cover that. Or financial implosion in China, really big deal. I got to cover that. Or what's going on in the U.S. and other topics. I could give you a long list. Maybe the end of the dollar's role as a global reserve currency, et cetera. The difficulty now, they're all going on at once. Like, any one of those topics would, fill a newsletter or be a big topic, a heavy lift, but they're all going on at once. And number two, they're not unrelated. There are all kinds of correlations. The breakdown and collapse of the global supply chain, which preceded COVID. A lot of people say, well, COVID came along. Of course, it messed up the supply chain. In my new book, Sold Out, I've got very, very good documentation that shows the supply chain was breaking down before COVID. Now, of course, COVID made it worse. Yes. And the war in Ukraine made it worse yet. Yes. But this really started with Trump's trade war in 2018. So, that, like I said, there's a thread that runs through all these things. So, when you ask me that, I'm thinking, well, you want to talk about China, Ukraine, supply chain, they're all a big deal. The war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. If Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these things are going on at once. It's interesting because I do have, kind of an international following, but there are certain pockets. I mean, there are certain countries where, there's interest in what I do, or my books are published in that language, et cetera. So I have a good German following, and of course the Germans want to know what's going on with energy, and Japanese followings. The number one question, of course, everyone's concerned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your, ability to feed your family or keep a roof over your head. So people get inflation. It's one of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming. And there's data. I never make statements like that without supporting it. There's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still, the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, and there's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on. I mean, that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Berry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions, and they're saying the same thing. So, so every now and then someone will throw some statistic at me and I go, how long is your time series? And I go, oh, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's the greatest bubble of all time, real estate, stocks, and other asset classes. So, I do, that is my view, but it's shared by a number of other analysts. And again, you have to remind people, 1929, everyone's like, October, I think 18th or 19th. It was late October 1929. The stock market fell 22% in 2 days. It wasn't one day. It was, it was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. I mean, that was the beginning of the crash. This Dow Jones fell 82%. From top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happens. So yeah, we're down. Nasdaq's down. Bounced back a little bit, down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, full market adjustment looks like in the face of the kind of recession that I expect. The soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing. That's not priced into markets. The markets are pricing in a soft landing. They're not pricing in a really hard landing. So you have what's called cost push inflation. That's where supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or kind of do without. We are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food, because you're moving it by truck, et cetera. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation, and you see that in inflationary expectations and inverted yield curves. And I'll come back to that because that's a really big deal. If you thought inflation was going to run away, as it did in the 70s, yield curves would be steeply sloping, and people would be in a frenzy to buy stuff. They're not. And the yield curves are not sloping, or upward sloping. They're inverted. They're going down. That tells you that, and we also see it's inflationary expectations. Inflationary expectations don't drive inflation here and now. What does is inflation here and now can feed on itself. Inflationary expectations don't drive it, but they tell you a lot. They're information rich. They tell you a lot about what people expect. What the yield curve is telling us, what inflationary expectations are telling us, and other factors are telling us is that, there's inflation now, but the Fed's going to kill it, and they're going to kill it by destroying demand and throwing us into a recession. And here's where it gets interesting, because you could flip from this kind of inflation to disinflation or even deflation very quickly. And people are definitely not prepared for that. Well, sorry, I shouldn't say that. Kind of everyday consumers are prepared for it. I'm not sure Wall Street and mainstream economists and policymakers are prepared for it. They're just extrapolating the inflation, saying, well, the Fed's going to kill it. Yeah, they might kill it, but at a price, at a very steep price. And consumers are really bracing for that. So the soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing. But that's not priced into markets. The markets are kind of pricing in a squishy landing or soft landing or from the runways. They're not pricing in a really hard landing, and that is what we're going to get. We may have a very bad recession, possibly worse than 2008. So tell me why it's a buy signal for stocks if the Fed is throwing the economy into such a bad recession that unemployment is going to go up significantly and growth is going to come down, inflation is going to come down. Why is that a buy signal for stocks? Maybe at the bottom, and the bottom might not be till late 2023. Okay, there are opportunities to buy the bottom, but we'll be nowhere near the bottom. Bear market rallies are really interesting. Some of the biggest rallies in history have been in the middle of bear markets, where you ended up losing everything, but for a couple of days or weeks even, it's the bottom's in, and you buy stocks, et cetera. So you have to watch out for that. So we're flying into a really bad recession. The stock market's starting to get the message, but you've got this pivot narrative you can't quite get rid of. Some of the buy the dips people are still around, so count on them to buy into what could be a horrendous bear market. You got your buy and hold crowd. Remember in 2000, 2001, the Nasdaq dropped 80%. And a lot of people got out, but they said, well, just hold on to it. Well, it did come back, but it took until 2015. I mean, that's a long time. A lot of people died in the meantime. You're waiting 14 years to get back to where you were. So those people are still around, but there is what I call the pivot crowd. So the Fed pivot is a narrative, and it kind of goes like this. Yeah, the Fed's tightening. We see that. Inflation is going to come down really fast. The economy is going to slow down really fast. Both of those things are happening. Inflation, a little less so, but the economic slowdown is there. And the Fed's going to get the wake-up call and have to cut rates. And cutting rates, that's the pivot. They're going to pivot from rate hikes to rate cuts. And that's good for tech stocks, so buy stocks. Now, that's the narrative. It prevailed in late July and most of August. The stock market did go up. There was a decent rally in the middle of what's become a bear market based on this Fed narrative that they were going to have to cut rates. There are two huge fallacies in that narrative. The first one is who says the Fed's going to get the message? And if you look at what Jay Powell said and what he repeated, we're going to raise rates. We're going to crush inflation. I've been following this for 50 years. I've never seen a Fed chairman use the word pain 3 times in one paragraph, but he did, and he meant it. He knows there's going to be a recession. They're causing it in part. Unemployment's going to go up. He said that. He tied unemployment to killing, basically demand destruction and getting inflation under control. He said, that's how we're going to do it. And you're already starting to see some early signs of that. So with that as their focus, who says the Fed's going to, get a wake-up call? Almost certainly not. I mean, they told us what they're going to do. They're going to raise rates. And then he said, if we see progress on inflation, we'll pause. But pause doesn't mean cut. It means just wait a long time, because at that point, core PCE, that's personal consumption expenditure, core, which excludes oil and food, and that's just how they do it. That's their favorite metric. You can debate whether it's the best one, but the debate doesn't matter because that is the one they use. Let's say that comes down to around 3.5. Okay, it's still not 2. Now, what Powell, which is their target, so what Powell said is, we don't have to keep raising rates to force it to 2. We just have to raise them enough that it'll get to 2 on its own. That's what they call restrictive policy. So, but that's not a rate cut. He said that might last for a year, all the way into 2024. That's when he was talking about rate cuts. Now, again, this can change, but they've told us what they're going to do. I always say, forecasting the Fed's the easiest thing I do, because they actually tell you what you're going to do, what they're going to do. You just have to listen and believe them. Now, the hard part is understanding how badly they're going to destroy the economy and when they're going to get the wake-up call. That's the hard part of the analysis. But telling what they're going to do is the easy part, because they kind of tell you. So the stock market notion that somehow they'll be cutting rates is just false. I was around for the 2008 financial crisis. I was around for 1998 financial crisis. I negotiated that bailout for LTCM. 98 was interesting because it was an acute financial crisis that came very close, within hours, actually. And I was in the room with the Treasury and Italian finance ministry and 19 banks and a thundering herd of lawyers trying to save the world. But we came within hours of shutting every market in the world. There was a $4 billion all cash. You couldn't use the word due diligence because there wasn't time. It was just, hey, the Fed wants us to do this, so let's just do it. So that worked. But it was a very close call. They would have shut down Tokyo and then around the world, London and finally New York. And they would have opened days later. But that's how, with trillions of dollars of losses, it would have been worse than what actually happened in 2008. It didn't happen, but there was no economic recession at the time. That confuses a lot of people because, and particularly if you're using 2008 as a frame of reference. There are financial panics and financial crises and liquidity crises, and there are recessions, some of which are severe. But they're two different things. 98 was an acute financial crisis with no recession. 2000 was a mild recession, but there was no severe financial crisis. Now, NASDAQ collapsed, but there wasn't a lot of leverage in NASDAQ. There was no contagion there, but it didn't spread because no banks failed, no major brokerages failed, et cetera. So in 1990, a mild recession, but no financial panic. October 19, 1987, interesting, stock market fell 22% in one day. Not a week or a month, but one day, down 22%. And that was a financial crisis, but there was no recession. So they're separate things. However, they can happen together. And 2008 was an example. There we had both. But I would encourage analysts to separate those two things. Again, they came together. It was horrific, but they can happen separately. My point is, What's coming is a very severe recession. The monetary tightening on top of a world where growth is deaccelerating, inventories are sky high. The funny thing about the supply chain, we all remember headline, supply chain's broken down, the shelves are bare. So all true. That was happening at the time, and that's when I started working on the book. But what a lot of purchasing managers did, and inventory managers, they doubled their orders. They said, well, or tripled the orders. They said, well, if the supply chain's breaking down and I want just a normal amount, I better order 3 times as much or twice as much just to get what I want. And they did. Well, what happened was by the summer, some of that pressure had been alleviated, and here come the shipments into the warehouses that are twice as much or 3 times as much as what you needed at the exact same time that the Fed was destroying demand. And so demand drops off a cliff, retail sales drop off a cliff, the warehouses go from being empty to being full to the rafters, and now all that merchandise is sitting there. So, Nike, just many examples. So what do you do when you're in charge of inventory? You cut prices. You don't want that inventory. It costs a lot of money to keep it in the warehouses, number one. Number two, a lot of it's seasonal. It's like, who wants to buy, a summer dress in December? Not too many people. So they just slash prices, and that reduces margins and reduces profits. So we're just kind of flying into the face of all that. With the Fed tightening rates into weakness, the Fed will be the last to know because they're very model driven and the models are badly flawed, mostly with the Phillips curve and their focus on the unemployment rate, which is not a good measure of what's going on in the labor force. So my expectation is the recession's coming. It's going to be really bad. Inflation is going to come down fast, but not quite fast enough for the Fed. They're going to keep raising rates, destroying demand, raising unemployment. And we're going to wake up with a severe recession, high unemployment, and a much lower stock market. The bond market is telling a completely different story, by the way. And this is a little more esoteric. But if you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German Bunds yield curve, they're all inverted. They're all inverted. Now, inversions happen, just meaning the longer-term rate is lower than the short-term rate. We're seeing something globally we've never seen before, and it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no. This is bad, and it's going to get worse, and it's actually too late for the Fed to do anything about it. See, when these inversions start, sometimes they're a year forward, like, hey, look at the Euro-dollar futures yield curve a year from now, man, that thing is inverted. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So that's like a big red siren, flashing light, whatever you want to call it. Okay, whatever your baseline is, probably treasuries, 2-year notes or 5-year notes or whatever, they will come down a lot. Not right away. We may still be a month or two away on this, but they'll come down a lot. And then corporate yields will go up a lot because of the recession, because of deterioration, increased bankruptcies, reduced revenues, et cetera. So those spreads will blow out. And it's important to remember, interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get close to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. The yield curves I was talking about are very good forward indicators. They tell you what's going to happen next. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out. later. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I said, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. Interest rates peak after the recession has already begun. So interest rates may not have peaked yet. I mean, even the treasury market. So that's not unusual. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Well, the answer is they have to announce the layoffs. There's all kinds of statute, SEC. So if I'm going to fire 10,000 people, I got to tell the world I'm firing 10,000 people. It doesn't mean I fire them that day. I might fire them on a rolling basis over the next 30 days. And it doesn't mean they walk out the door empty-handed and head for the unemployment office. I might give them 3 months severance, 6 months severance, et cetera. And so when do they actually show up to the unemployment office and say, give me a check? It might not be till this spring. So the layoff announcements are out there, but the unemployment rate hasn't budged because there is a lag, 3 months. But that's why I said interest rates lag the business cycle, and they do. Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights, find a cheaper laundry, whatever it takes. By the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. And then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. But we know enough right now to know that number's going up. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect. That unemployment's a lagging indicator. So when the Fed's on a mission, they actually don't care about the stock market. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, if stocks are going down, but it's, kind of little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic. It dropped like 30% in like 2 or 3 weeks. The fall of 2008, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly. That may happen. In fact, I expect it will, but we're not there yet. So there may be a pivot, in late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. And I see a much more severe recession. Now, the other half, what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got 3 Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling 3 different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality, and I guess I'm the storyteller here, but what I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened, and they may pivot to say that there could be a rate cut in August. Maybe, I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real, it's not because they engineered a soft landing and Goldilocks and everything. Oh, it's just right. It's because they screwed up as usual, as they've been doing since 1913. They over tightened and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre, and after most of the 20% collapse had already happened. They tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. The Fed can't escape the room. So if inflation stays where it is, the Fed can't get interest rates to a real level without causing a recession, which will sink the stock market. But even if inflation comes down a little bit, that'll be a sign of recession. So you're raising rates into a recession, which will cause a recession. You end up in a recession either way. It's just a question of whether the Fed persists or throws in the towel. Now, we've seen this movie before. What's going on is an exact replay of what happened between 2013 and 2019. May 2013, Bernanke announces the taper. Expectations are going to start the taper in September. He chickens out. They start the taper in November 2013. They finish the taper in November 2014. Then here comes Yellen. She's going to raise rates. Take out the word patient from the statement. She doesn't raise rates until December 2015. And then she doesn't raise them again until December 2016. They went a whole year between two 25 basis point rate cuts. And then here comes Powell, and then boom, okay, 25 basis points, boom, boom, boom. Gets them up to 2.25, which is where they want it to be. And gets the balance sheet down to about $3.5 trillion. They want to get it down to about $2.5 trillion. But he's got rates about where he wants them. He's got the balance sheet on its way down. And he's normalizing. And what happens? The stock market crashes 20% between October 1st, 2018 and December 24th, 2018. That was the famous Christmas Eve massacre where the stock market fell 3% in one day. But the Fed's still tightening. The Fed tightened like a week before the Christmas Eve massacre. They tightened into the weakness. They were getting very close to crashing the stock market. They took it down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out, okay, we're not going to raise interest rates anymore. We're going to be patient. They use all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE, I forget if it was 8 or 9, whatever, lost track of QE. He starts QE 8, let's say. And then that takes you into 2020, and here comes the pandemic, and rates go down to 0, and the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen, and it's not clear which, but it's going to be one or the other. They're going to keep tightening and keep tightening and keep tightening, try to get a handle on inflation and crash the stock market, or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November, but the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either because the Fed doesn't drill for oil, they don't build pipelines, and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here. The supply chains are getting worse. But these supply chain disruptions didn't start with the war. They didn't even start with the pandemic. They started with Trump's trade war beginning in 2018. I found a very good book on that written by Lorianne LaRocco. And what's interesting about her book is that she finished it in late 2019. So it's almost like a controlled experiment. It was pre-pandemic. It's easy to say that the pandemic disrupted the supply chain, which it did, and the war disrupted the supply chain, which it did. But here we have a very rigorous study of what was happening to supply chains before either one. And the answer is they were a mess. They were a mess back then because of tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That sounds easy because Brazil grows soybeans. Well, guess what? You got to get the ships to Brazilian ports. You got to rearrange all the logistics lanes. That was happening already. Pandemic made it worse, and now the war makes it even worse than that. Yeah, the world is breaking up. We're decoupling. Globalization is over. There'll be a new form of it. It's not the end of world trade, but you're going to see, maybe the Five Eyes, UK, US, Canada, Australia, New Zealand, and friends in Western Europe form a new trading bloc, but exclude China and Russia. It'll be a little bit more like the Cold War. I talked to Paul Volcker about this, but here's what happened in the 70s. Now, it started as cost push inflation. It was the Arab oil embargo in 1973, after the 1973 war, the Israel-Arab war. Then the Arabs threw the embargo on us. The price of oil quadrupled. It went from $3 a barrel to $12 a barrel. It sounds cheap, but that's a 300% increase. And then we had a severe stock market crash and recession in 1974, which at the time was the worst since the Great Depression. We've had worse ones since, but at the time, that was the worst recession since the Great Depression. Then we come out of that, and along comes the Fed, and we went off the gold standard. Nixon had an easy monetary policy in 72. It was a little earlier for his reelection effort, et cetera. So here comes the inflation. But what happened along the way, and then you had another Arab oil, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were double oil shocks. That was supply-driven cost push inflation. But along the way, it morphed into demand pull. It morphed into a demand-driven inflation. Now, I lived through it. I mean, I was a young, up-and-coming lawyer at Citibank and a senior officer living in New York City, and that was the world where if you wanted anything, new furniture, TV set, vacation, whatever, you ran out, you dropped everything, ran out and did it because the price was going up so fast. So that's instructive in two ways. Number one, it shows that the Fed's always behind the curve. It shows that these things can persist a lot longer than people expect. But in my view, most importantly, because I think things are going to happen more quickly now, it shows inflation morphing from cost push to demand pull, morphing from something on the supply side to a psychological shift on the consumer side. And Volcker crushed it, but at a huge cost. Unemployment was about 11%. He took interest rates to 20%. How does that feel? Mortgagors and student loan holders and others, 20%. You talk about 40% on credit cards in that world. And people forget, doesn't inflation, don't you have high growth or whatever, at least, or low unemployment? No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We had 3, 1974, 1980, and 1981, which lasted until 1982. And by the way, people lost confidence in the dollar. In the late 70s, Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now, it was Treasury debt. You had the Treasury credit, but it was denominated in Swiss francs because nobody wanted dollars. That's how bad things were.